The market cipher reporting 1.3 million ounces of silver vanished from COMEX vaults. Silver was at $89.70, pushing toward $90. Then CME pulled the plug, trading halted, screens froze, and while every retail trader on Earth was locked out, over 1 million ounces of physical metal walked out of registered inventory. Not before the halt, not after, during. That is not coincidence, that is coordination. And what happened in those frozen minutes tells you more about this market than a month of price candles. Let me walk you through exactly what happened and why the timing tells you everything. Silver had been rallying for 3 consecutive sessions. War escalation in the Middle East, oil spiking on Strait of Hormuz disruption, physical demand from Asia showing no signs of slowing. All forces pointed up. The $90 level was not just psychological. Options strike clustering sites heavy at that number. A clean break above $90 triggers a cascade of call exercises. Market makers holding those short calls face significant delivery obligations. Silver hit $89.70. Momentum was building, and then the CME halted trading for market integrity purposes. That is not a theory. That is observable. Now here is what happened in the vaults while the screens were frozen. During the halt window, COMEX warehouse reports show 1.3 million ounces withdrawn from registered inventory. The breakdown: 412,000 ounces from Brinks, 367,000 from CNT, 521,000 from MTB, smaller adjustments across Loomis and Delaware. For context, the average daily withdrawal over the past 30 days has been approximately 280,000 ounces. This single withdrawal was 464% above the daily average, concentrated into the exact window when trading was suspended. The metal did not move to eligible status. It left the COMEX system entirely, withdrawn, removed, gone. COMEX registered silver now sits at 78.4 million ounces. That is the metal actually available to settle futures contracts. Against that, open interest represents approximately 540 million ounces of paper claims, a leverage ratio approaching 7-to-1. For every physical ounce in registered, there are nearly 7 ounces of paper promises written against it. The 30-day drain rate is now 51.2 million ounces. At current pace, registered inventory depletes entirely within 46 days. That math resolves in one of 2 ways. Either metal flows back into the vaults at scale not seen in years, or price moves sharply higher to ration access to what remains. There is no third option. Now here is where the Shanghai market tells a different story than what COMEX is showing. While CME had screens frozen at $89.70, Shanghai Gold Exchange silver was trading at $102.40. That is a $12.70 premium, nearly 14% above the Western paper price. Shanghai did not halt trading. Shanghai did not freeze screens. Shanghai let price discovery continue, and the price that market discovered was significantly higher than what COMEX was showing before they pulled the plug. The gap between paper and physical is now the widest since March 2024, and that gap is the market telling you something important. Paper says silver is worth $89. Physical buyers in the world's largest demand market say it is worth $192. When paper and physical diverge this far, one of them is lying. The physical market has no reason to lie. It needs the metal. This brings us to what was happening in oil, because these markets are not moving independently. WTI crude closed at $91.50, up 34% in a single week, the largest weekly gain since 1983. The Strait of Hormuz remains functionally closed to vessels linked to U.S. or Israeli interests. Roughly 20% of global oil supply is currently constrained. The U.S. Treasury announced a $20 billion reinsurance program just to keep tankers moving through the strait. That is not normal. That is crisis infrastructure. War escalation continues. Iran launched additional missile strikes. Ground operation discussions are reportedly on the table. Every macro force says precious metals should be breaking higher. Oil says up. War says up. Physical demand says up. Shanghai says up. Yet CME halted trading as silver approached $90. Someone said no. Now here's the vault math that nobody is talking about. Total COMEX silver inventory stands at 348.7 million ounces. That sounds like a large number until you break it down. Registered silver, the metal available for delivery against futures contracts, is 78.4 million ounces. Eligible silver metal stored but not deliverable is 270.3 million ounces. The leverage ratio on registered is now 6.9-to-1. For every ounce available for delivery, there are nearly 7 ounces of paper claims outstanding. In the last 30 days alone, 51.2 million ounces have left COMEX vaults. That is a 12.8% decline in total inventory in 1 month. At current drain rates, registered inventory has 46 days of supply remaining before mathematical depletion. That does not mean silver goes to zero in 46 days. It means the current system of paper price discovery breaks. Either significant metal returns to vaults, or price rises to levels that ration demand and incentivize metal flow back into the system. That is not opinion. That is arithmetic. Now here is why the timing of the CME action raises questions. The CME has full authority to halt trading for what they term market integrity. That authority is not in question. What is observable is the timing. Silver was at $89.70, pushing toward $90. Momentum was accelerating. Halt triggered. During the halt, 1.3 million ounces left registered inventory. When trading resumed, silver reopened at $86.20, below the critical $90 level. Halt at $89.70. Withdrawal during halt. Reopen at $86.20. Two events, same window. Price back below resistance. The timing is suspicious. Now the bear case, because it is real and you need to understand it. The paper market can push prices lower regardless of physical tightness. The 6.9 to 1 leverage ratio means a coordinated paper sell-off can overwhelm physical demand in the short term. CME can raise margin requirements. They have done it before. They can impose position limits or liquidation-only trading if they choose. Dollar strength would add technical pressure. The DXY is currently at 104.2, and a reversal higher would create headwinds. War headlines shift quickly. Even a rumor of negotiation can trigger algorithmic selling across metals in minutes. None of that changes the structural picture, but it can delay the tape. Connect the dots, and here is where you land. Silver was pushing $90. CME halted trading. During the halt, 1.3 million ounces left registered inventory. When screens unfroze, price reopened nearly $4 lower. Shanghai maintained a $12.70 premium throughout. Oil closed at $91.50. War escalation continues. Every fundamental force pointed higher. Yet the paper price was walked back below resistance during a trading halt. Registered inventory has 46 days remaining at current drain rates. The leverage ratio is approaching 7 to 1. Physical is leaving. Paper is being managed. Two outcomes remain. Metal returns at scale, or price adjusts to ration what remains. There's no third option. Markets open into all of this. What happens in the next 48 hours will determine whether $90 holds as resistance or becomes support. The vault drain is documented. The halt timing is observable. The Shanghai premium is verifiable. The leverage ratio is arithmetic. 1.3 million ounces vanished while CME had the lights off. Silver was pushing $90 when they pulled the plug. The rest is for you to decide. Invest with clarity, not noise. We'll see you in the next one. The Market Cipher, signing off.